Hey everybody, it's John King with Summit Funding, and it is Friday the 16th of June. Super excited to be back with you. I was last week headed out on a trip, went to Washington, D.C. and New York City with my son's 8th grade school classmates. And super fun trip, had a really good time, saw some amazing things, got to actually be in D.C. when the Federal Reserve sat down to meet, and they invited me in to get my input. Not really. That would have been cool though. But anyway, super fun trip. Glad to be back with you. Let's go ahead and dive into what I'm going to cover today. So first of all, I'm going to talk about the outcome of the Fed meeting and really where do rates go from here. I'm going to talk about the sting of temporary buy downs because they're starting to sting right now and explain to you what's happening with that. We're going to talk about the summer slowdown. What is the summer slowdown? Are we going to see it? We're going to talk about updated median income limits. And finally, I'm going to finish out with the benefits of being a first-time home buyer. So let's go ahead and kick it off. The Federal Reserve met this week. They had their announcement on Wednesday, and for the first time in the last year and a half, they did not raise interest rates. That should be a reason to cheer. That's what we've been waiting for, is for the Fed to signal, hey, we're done. We've hit the top. We're going to start coming back down. And it was wholly expected that when the Fed does that, the mortgage market, the stock market's going to react in a favorable way, saying, man, the Fed is pausing. Well, that really is their simple way of saying we're stopping and we're going to start going down, because historically, every time the Federal Reserve has raised their rate so quickly, it's always led to a recession. Well, that isn't necessarily happening as quickly as people would have thought. And so the Fed now has said, hey, we're going to pause. But they did one thing that was a critical change, which is that they adjusted their forward-looking guidance. In other words, every meeting they put out what's called the dot plot, which is every Fed chairman saying, hey, let's chart out where we think interest rates are going to be and where we're going to have our rates over the next year and 2 years. And the Fed has basically, in their forward-looking guidance, says we expect to raise rates 2 more times this year. So although they paused, they said, this is just a pause. We really think we're going to continue to raise interest rates, and the markets have not liked that. And so it's caused mortgage rates to actually go up over the last couple of days, huge amount of volatility. And the question is, where do rates go from here? Well, we're still staying within the range of around 5.75 at the lowest to around 7.25 at the highest. And we're still within that range. So I think we're staying within that range, but I don't think we're falling as quickly as we would like. Now, once rates really start falling, they're going to fall quickly, because when there's a change in the direction of the Fed, when the Fed is clearly saying we've changed our tune, and so the question for now is, what does that mean to the markets? Because we're going to end up, in my opinion, staying for an extended period of time in this 5.75 best case to 7.25 worst case for the average 30-year fixed. Well, a big piece of that has to do with temporary buy downs and what everybody's expectation was. Temporary buy downs are a lowering of your interest rate for a short period of time. They've been around forever and ever and ever, but they really came into play last year as rates started going up. And everybody said, and I mentioned it too, hey, we expect interest rates to be lower by 2023 to 2024. And so one way to take the sting out of these higher interest rates is to temporarily lower your rate and lower your payment, front loading your savings with the expectation that interest rates are going to be lower by 2023 to 2024. Well, a lot of people did something called a 2-1 buy down or a 3-2-1 buy down that gives you 1 year at the largest amount of payment savings. And then at the end of that year, your payment goes up a little bit. Let's say you had a 2-1 buy down and the rate was at 6%. For the first year, you're at 4%. But at the end of the first year, your payment jumps up to a 5% rate, and you're making a payment based on a 5% rate. For a lot of people, they're going to feel that sting in these months right now, and not going to cause foreclosures. Look, these people were very, very well qualified, unlike 2007 and 2008. So I'm not worried about there being a huge foreclosure crisis. What I'm worried about is just people thinking, hey, I was sold this temporary buy down and I was sold that I was going to have this payment and I'd be able to refinance before the payment went up. Well, guess what? That isn't happening. Your interest rate is going to go up and you are not in a position to refinance right now. And so people are going to feel that sting. And I just feel the frustration because everybody has expected this market to turn faster. We saw a huge rise up quickly, and everybody, including a lot of the experts that I trust and I follow, expected rates to really start dropping about a month ago, and we're not seeing it. Inflation has come down, but we're not seeing interest rates drop as much as we would like because we're not seeing recessionary flags. We're seeing the economy still chugging along. We're seeing jobs being really, really strong. And so these people that had a plan, some lenders are saying, hey, I'm sure that rates are going to be down by mid-2023. Well, guess what? That isn't happening. And so there's a major cause for concern simply for the budget and the expectation of the people who did a temporary buy down, especially if they were sold that they are sure to be able to refinance before that interest rate starts going back up. What's the summer slowdown? The summer slowdown is typically where people are not buying homes as much because the peak of home buying happens in the spring as people are saying, hey, I want to move right when my kids get out of school. And so they start putting their house on the market. They start searching for a new house in the spring to close right as school is ending. And then they're on summer break. And nobody wants to be moving and looking for homes and all that kind of stuff during summer break. And so you kind of feel a little bit of a slowdown during the summertime. Well, the problem is we never really had that spring pickup. Now, we also normally will see a pickup in the fall. People are heading back to school and saying, okay, I want to get into the new school district before school starts. And so they'll see a pickup in activity in the fall. But summer, normally you see a slowdown. The problem is that we robbed a lot of sales. A lot of transactions people were going to do in 2023 were done in 2021 because those people could get super low interest rates and they bought a home prior to or earlier than they were originally planning. And so we robbed a lot of the business that's supposed to happen today, and rates have stayed high. And so a lot of sellers are saying, you know what, there's no point in me selling because I'm not going to save enough money. I had a client that I talked to yesterday that was in exactly that situation. A couple that's looking to downsize now that they're retired, and they're looking to sell their home and buy something $100,000 cheaper than what their current home is, and their payment's going to go up. Their payment's going to go up pretty significantly. Even though they're taking all the money from the sale and putting it into the new house, their interest rate is going up so much that it just didn't make sense for them to sell. That's another home that didn't go on the market, which is really our biggest challenge right now, is we're not seeing inventory. And we're seeing even the buyers who are coming out right now, I do see buyers being more tolerant of these interest rates. They've kind of gotten used to it. You've heard me talk a lot about recency bias. People are biased to what has happened most recently, and recently rates have been high, and so people are comfortable with the fact that rates are going to stay high. All right, so a couple of quick hits and I'll let you go. Updated median income limits were published last week. Once a year, the income limits are updated in June. That affects Cal HFA. It affects some other down payment assistance programs. It affects programs such as certain interest rate driven programs on if you're below 80% of the area median income or 120% of the area median income. Those income limits have changed. They went up a little bit. So you can check out, we'll put the link down below to the lookup. You can look up by county and see what the median income is. But really what programs those help you with and how they help you comes to me being an expert in guiding you. And speaking of being an expert in guiding you, I've got a live broadcast that I did today that is about what does it mean to be a first-time home buyer? Why does it matter? What benefits do I get? And what the heck is the definition of a first-time home buyer? So tune into that. The link for that is also down below because it's really, really good information that I want to help you get out to everybody that you know. Because a lot of people talk about, hey, I'm a first-time home buyer. What does that mean? Or, oh man, it's too bad I'm not a first-time home buyer. That means I can't blank blank. Well, guess what? Oftentimes you can. So there's a lot of misinformation about being a first-time home buyer. Listen to the live stream that I did on what it means to be a first-time home buyer to educate yourself, your family members, and your friends so that you get all of the advantages that are due to you if, in fact, you do qualify as a first-time home buyer. Thanks for everything. Appreciate you listening. Appreciate you liking, commenting, and sharing, and I hope you have a wonderful holiday weekend. Talk to y'all soon. Bye-bye.